Hello and welcome to the Your Financial Pharmacist Real Estate Investing Podcast, a show all about empowering pharmacists to achieve financial freedom through real estate investing. I'm Nate Hedrick, and each week, my co-host David Bright and I explore stories from pharmacists all over the country who are achieving their real estate goals while maintaining a meaningful career in pharmacy. Whether you're a first-time investor or a seasoned pro, we're here to provide education and inspiration about the world of real estate. Please note, this podcast is intended for educational purposes only and should not be considered financial or investment advice. Hey, David, how's it going?
Hey, good. Thanks. How you doing, man?
Good. Getting rolling here now that it's 2023, making some game plans for the year for real estate. I know last year was kind of a crazy year for us. We pulled back quite a bit in real estate. The market shift caused us to pull back. And so hopefully I can spring forward this year with a little more setup in 2023 in January here.
Yeah, that market shift was pretty wild and pretty fast. And it sounds like it's still shifting in some areas. Yeah, and for different business models, that can really be a thing. I know we just put an offer on a house today. Fingers crossed that one goes through. So we'll see. I think some deals are out there depending on what you're looking for and what your business model is. But yeah, it's really interesting to talk with different people about what they're doing in this market. Because when I talk with other investors or when I go to real estate meetups, I hear a lot of conversation about like, what's going on in this market and where do you think this is going next? Because those kind of questions really serve up a lot of the foundation of real estate strategy moving forward. And I know that's why we wanted to record last week's podcast about predictions and thought process and all that for 2023, so that then we can springboard off of what might be going on. What are these predictions? What are the kind of things that everybody is seeing? And then let's put that into action as far as, so what do we do about that in 2023?
Yeah, and if you missed last week's episode, David and I made 3 wild predictions for 2023. Would love for you guys to check that episode out or to come on to the Facebook group, YFP REI Facebook group, and combat those opinions, agree with those opinions, give us your own opinions. We're all trying to figure out what's going to happen next year or this year rather, and it's a good time to kind of have that conversation. And even though, our opinions might matter very little for your particular market, it still gives you an idea of what predictions you need to be thinking about, and then you can base a strategy on there based on your own individual market and your own shifts that you're seeing.
Absolutely. So to show then what we're talking about from that too, we wanted to follow up last week's wild prediction episode with these 2023 strategies, going from predictions to strategies. So again, this could be very different depending on your investment model, depending on what part of the country you're in. So we want to stick again to thought process and rationale, just kind of like we did last week, where the predictions matter not as much as how we got there. So we'll do the same thing here. We wanted to try to connect those dots with what to do about those predictions moving forward.
Yeah, absolutely. And I'll put my realtor hat on for just a quick second and just emphasize that again, real estate is local, right? We're going to tell you some trends, but those trends can be totally different in your market. I mean, I'm seeing, even in my own broad market, there are neighborhoods where I'm still competing with others on multiple offers and other areas where a property won't move for weeks. So it's very localized. It's very specific to your individual market. And keep in mind too, that even though we like to think, right, I always like to think in 12-month blocks, right, year-long blocks, the calendar year does not necessarily mean the market year, right? It can shift at any time. It can change at any time. And so just because we plan things out in these nice chunks of 2023 versus 2022 doesn't mean that those trends are going to follow that same calendar year.
For sure. Speaking of those trends and what we've seen, how about we just walk back a little bit into last week in terms of some of these predictions? So just to make sure we're all on the same page, Nate, can you bring us up to speed on what were some of the 3 key predictions that we had last week?
Yeah, so I mean, we gave a whole bunch of Tim Baker answers, right? It depends, but we try to put some real numbers on there for you guys. And so the 3 major concepts we talked about. First was interest rates. We think that, with interest rates being much higher than they were a year ago, that's going to continue to fluctuate, right? There's arguments for it going higher, arguments for it to go lower, arguments for it to stabilize. And so we kind of gave our predictions on that. The next part was on rent rates and the rent prices rather. And we've seen that cooling in some places. And our expectation is that the high cost of living areas, we're going to see further cooling, whereas the more middle market areas, lower cost living locations, those we're going to see continued price increases or at the very least some stabilization. And then we talked about house prices in general. And again, there's tons of opinions out there about whether or not they're going to drop or if they are going to drop, by how much. And so we gave some thoughts on that as well. So those were kind of the three major areas that we focused on and made predictions on in last week's episode.
Yeah. And I think I'll just double down on what you were saying about this all real estate is local, right? Because there's some markets that saw just absolutely incredible real estate price increases over the last 2 years. And so price corrections may mirror that huge spike. It may come down fast. It may be that markets that had lesser growth may have lesser dips. We'll just kind of see how this all plays out. But it does seem like in a lot of areas, this hysteria of the market, there were some that we would put on the market and yeah, so many offers so fast. It was just wild. And that's just not sustainable for these huge over asking price offers. So as we see some pullback from that hysteria, I think it's very reasonable to expect that some areas may fare better and some may fare worse in the market as a whole.
Yeah, so we're going to dive deeper into a few of those conclusions. Specifically, want to get into how we came to those conclusions. And again, if you'd like to give your own opinions, head on over to the YFP REI Facebook group, drop them in there. We'd love to hear more from you guys.
Yeah, but back to actionable next steps, because that's where we want to go. So Nate, can you help connect the dots as far as why someone might still want to buy real estate, even though a lot of people are predicting the prices may drop right now?
Yeah, it's a great question. And I think I'll tie this to something that a lot of other people are talking about at the moment. So if you were going to buy Bitcoin today, right? Talking about cryptocurrency on a real estate podcast. But, if you somehow had advanced knowledge and you knew it was going to drop by 5% this week, you probably wouldn't do it, right? You'd wait. You'd wait for that drop in 5%. But if you apply that logic to housing, it doesn't really work that same way. You don't have that crystal ball, just like in anything in stock market investing, in cryptocurrency investing. You just simply don't have a crystal ball. You don't know that it's certainly going to drop. And to make it even worse, we're not talking about just Bitcoin or just Dogecoin or pick your favorite cryptocurrency, right? Every individual house is different. So even though the general market might drop, here in Cleveland, we might be on the rise, or here in Solon, Ohio, we might be on the rise. Whatever it looks like, each one of those markets is going to be more and more specific. And then it's going to be even more street specific from there. So it's not something where you can say houses are going to go down in value. Even if you knew that 100%, that doesn't mean every single house is going to go down in value. So it's really hard for us to say, don't buy, we see a drop coming, because it's not applicable everywhere.
For sure. And I think that I like the city, the smaller part of the city, the block, and then even that house. Like we talk a lot about the Burr method, where you buy a distressed property, you rehab it, you rent it out, you refinance it, and then you have the option to repeat that process if you want. That's a lot of that comes in from bringing value through renovation. So as an example, if we want to talk about a house that my wife and I worked on last year, we purchased it for about $75,000 if we just use some really round numbers. And then we did about $25,000 in rehab costs. At the end of that project, that house appraised for right around $130,000. So we were all in on what we brought for $100,000, but it was worth a lot more, $30,000 more. And so in that case, we kind of rode some market appreciation. We weren't expecting it to be that all the way to 130, but let's say, again, round numbers, we were hoping for 120 and it came to 130. That's great news. In this market, if we're hoping for 120 and it drops to 110 or even 105, if we're all in for 100, that still may be a really good buy, particularly if it's a good rental. It's something we want to hang on to. It's in a good area. We're expecting longer term appreciation or rent appreciation, or if there's other upside to that. So even when you get down past the block level to the individual house level, there can still be deals out there to buy from distressed properties or properties that need a little bit of work, and you can create a lot of value.
Yeah, that's a great example of, again, even when the market, and you're talking about housing market in general, is doing one thing at a global level, individual houses might see very different trends. And again, that specific house may have not have been desirable because of the amount of work that was required, right? Not a lot of owner occupants want to buy that big of a project, perhaps, or maybe they're worried about the general market trends. And so they're saying, well, that house needs work and the housing market in general is going down, so I'm not going to bother with this, right? But if the market had cooled, like you said, you still would have bought that property below market value. So you can still assess deals this way, even if the market's going to drop. You just have to do it in a way that we didn't have to before, where you were always expecting the market to continue to increase. And it almost didn't matter what you bought, it was going to go up in value, right? You have to be a little more strategic about it this time around.
Yeah, and I think that's healthy. I think you can get into trouble when you're expecting that, oh, it doesn't matter. This house will be a deal because the market will save me, right? So
Yep.
I think we should talk about that a little more in a little bit here. But one thing that I'm also thinking as we look to 2023, if the typical buyer is scared of interest rates, they're scared of falling values, scared of the unknown, kind of like you're saying, that demand might be a lot less than the hysteria of mid 2022 when everybody was trying to snatch up those very few houses that were out there on the market. So if demand comes down and if supply comes up a little bit, there may be opportunities for real estate investors to buy discounted properties as well, because oftentimes we think of values and coming in on that back end on the sale and with demand. But as real estate investors with our purchasing hat on, if we don't have to compete in those multiple offer situations to buy things, there may be a lot more deals out there finding those properties that need a little bit of work where there's potential to add value. Those purchasing opportunities may become a lot more real here into 2023 also.
Yeah, I'm already starting to see that. I'm actually working on a deal right now with an investor client, and the property has just been sitting there. It definitely needs some work. It's a lot of cosmetics, but it needs a $40,000 injection of cash to make it a
Mhm.
viable place and really bring it up to the standards of the nearby area. And so people aren't really touching it, and we're working through negotiations, but we might be able to get a good deal on it. So it's those kind of things that you can start to look for when the properties have been sitting for a little bit longer. And again, just there are opportunities out there. You just have to be able to identify them and plan for them. And if we're looking at the big picture of where we're going, and you and I, David, talked before we sat down to record this, that there are kind of three key ways to manage that real estate investing in 2023 using that same kind of a concept. And a lot of this we can pull from the interviews that we've had with investors over the past year, right? A lot of individuals that are doing this and integrating into their business. And the consistent themes that we've heard from everyone that we've talked to are really one, run your numbers carefully, kind of applies no matter what the scenario is.
Mhm. Mhm.
Two, look to add value, right? Can you inject value into a property? Can you force appreciation? And three, don't count on the market to save you. Again, like I said before, we're seeing a ton of people that last year looked like geniuses no matter what they bought because the market came in and, a rising tide raises all boats, right? But if the market is starting to fall, even if it doesn't, you want to be planning like that market will not be there to save you. Basically, the market rise will not be there to save you.
Right.
So, David, I think with those ideas in mind, and you're starting to run numbers, let's break those down. Can we get into the specifics on some of those?
I think that we really need to emphasize the math and the numbers because we've talked several times about getting your math right. And I like that we've heard from so many guests on the podcast this year that have talked about how it's so important to just stick with those fundamentals and making sure that the math checks out, not falling in love with the property emotionally and then fudging the math, but like knowing that like this is what it's going to cost to do these things. And so because it is very easy to walk into a house and say, this layout is great, this neighborhood is great, look at this new flooring, this kitchen's beautiful, like those kind of things, and then start to overestimate some of that actual value. Even just with an investor hat on, even if you're not captured by those cosmetics, I think investors fall into a similar thing where you walk into a property or you see a property online and you see, this rent to price ratio is amazing. Like when I get out my spreadsheet, I know that this is going to be a great deal. And then you walk in there and you want to look away from the problems that start emerging as you look around the house. So it's really easy to convince yourself of a good deal, but parking that emotional attachment and focusing on the numbers is how you can make sure that that will be a good investment.
Yeah, I'll give you a good example of that from this past year. Actually, just a couple of months back, Kristen and I were looking at a property in Pennsylvania that was sort of this property that it was kind of the perfect sweet spot. It was 3 hours away. We could use it as an Airbnb, but we could also use it ourselves occasionally. And it was just this amazing 5 acre ranch that was built right alongside this river, this trout fishing river, and it was incredible. It was like exactly what we've been looking for, but it needs a lot of work. And so it was listed, I think, at 375 when we first looked at it. And we walked the property with some agents in the area. I made a ton of notes about what things need to be fixed up or rehab before we could even think to rent it out as an Airbnb. It basically came down to it was going to be about a $60,000 to $70,000 rehab just on the stuff that I could see without an inspection, right? It's a huge amount of work. And we started running numbers, looking at comps, looking at the dollars that would be coming in from an Airbnb perspective, running everything we could possibly think of from a math perspective. And to make everything work, we needed to be at like 280,000 for purchase price for this to even be remotely feasible in terms of value. And even though we loved this property, right, it would have been such a cool place to visit with the kids. It did not make financial sense. We would have been buying a property at a loss, and it wouldn't have panned out. And again, the goal was make it an Airbnb and then use it occasionally. But it was really easy to fall into the trap of, well, why don't we just use it a whole bunch and then occasionally Airbnb it, and who cares if we lose money? But like, we could not get into that mindset because it was an emotional decision, and we had to kind of step back and make a financial one. So I think that property is still on the market in case anybody's interested. But I think it's still listed like $350,000. So we're nowhere near close to being at the right value for it yet.
Yeah, and it's really important to look at those rehab costs too, like you mentioned, because those can balloon without realizing it. There was a property we looked at too that was also a short-term rental that we were really excited about. We thought this could be really fun. It was in kind of a historic district right by water. We thought this would be really cool. Got inside and looked at the basement, and there was a big foundation issue on one side of the basement where there was water coming in and the wall got pushed in and it was kind of collapsing. That felt really scary. And so we could look away from that and say like, well, maybe that could get cleaned up fast. Maybe we could get that done for a few $1,000s. But no, that's just looking around things because you fall in love with the property. So instead, again, we have a fantastic realtor that we work with. The realtor had a basement person. By putting all those pieces together and getting a much more reasonable quote of what that was going to be, we realized this just doesn't make sense. We can't make the numbers work. And so, yeah, on to the next house. Fortunately, there's a house on every corner, so we can keep looking and find something else. But yeah, those rehab costs, just getting realistic with what's going on matters.
Yeah, and if you're thinking about running your own numbers, again, use the experts around you, right? Either your realtor might know good rehab numbers, or you can get a contractor to give you quotes, and then actually put those into a spreadsheet, right? One of the worst things you can do is ballpark it on the back of a napkin and just guess and hope for the best, right? Because you're really going to set yourself up for failure. And if you're looking for a good spreadsheet in terms of, okay, now that I've got my rehab numbers, I want to put everything in and see what the return would look like on a BRRRR or on a buy and hold. We have a property analysis spreadsheet that David and I built. You can head over to yfprealestate.com, yfprealestate.com. There's a button right there that says download the property analysis spreadsheet. So really encourage you guys to check that out. Great way for you to run your math in the same way that David and I do. There's a bunch of notes all over the spreadsheet that kind of tell you how to run the numbers and why we're putting certain values in. So it's definitely worth checking out. yfprealestate.com for that one.
Yeah, I think that can be very helpful for the deal analysis, just to put it all on paper. It's numbers like pharmacists are used to looking at, right? So you could figure out if the return is what you're looking for and move on from there. So part of the deal analysis, one of the cells on that spreadsheet is the rehab costs. And really that goes into the value of finding ways to add value to a property through renovation. And so I really like the value add strategy because, again, kind of like the earlier example, if we're expecting that the house will be worth X number of thousands of dollars more than your all-in costs from purchase and rehab, well, then that creates a lot of cushion if the market drops. And so from just a safety standpoint, again, talking with a lot of safety-oriented pharmacists, that value add strategy by buying a discounted property and fixing it up seems like it can be a really good fit. Even if your rehab budget goes a little bit out of control or something else happens, if you have a decent margin in there between your all-in costs and what the property is worth, that can really be helpful at the end of the day.
Yeah, you're reminding me of a property we bought. I think it was last year or the year before, and it needed so much work, and it just kept getting worse, right? Every time we'd go to that house, I feel like there was another problem coming out of the walls. And so we just kept putting money into it. But the good news was we bought it at such a value discount that when we started adding that value back in, we took what was going to be becoming an uninhabitable property for a person that was actually living there and turned it around to something that was actually habitable and really nice. And again, it's doing really well now. It can be a challenge and it can be frustrating when things like that happen, when the dollars just keep kind of coming out of your pocket. But if you're buying right and you're expecting the worst to happen, right, and you're adding in these extra costs and the potential for these extra costs, you can still be successful even when that does occur. It just has to be bought at the right price point.
Yeah, and I think you make a really good point there too about needing that emergency fund for that house, because no matter how much inspection and contractor walkthroughs and estimates you do, there's still stuff that comes up, right? And things that happen along the way that need to be corrected. So We just had a main sewer line go out on a property a couple weeks ago that ended up being several $1,000s that we weren't expecting, we weren't planning for, but stuff happens, and so you need that emergency fund there. Sometimes it's stuff like that that can drive up value by making repairs. Sometimes it's cosmetic updates that drive up value. If you're buying a super ugly house that's just dirty inside and no one wants it because it just isn't clean. And so by cleaning it and doing paint and flooring, you can increase value. Sometimes one of the other strategies we've talked about is buying a house with a problem tenant situation where maybe the landlord owner is just frustrated with the whole thing and they just want to sell the house with a tenant in it. And you may be able to buy it and move on from there. Either help the tenant find a new place to live or get the tenant back to paying again. We had one where the tenant and the landlord just we're not getting along. We bought the house, and by going in and showing good faith and making a few $1,000s of fixes right away after we bought it, the tenant went from not paying to paying, and they're happy and they want to stay there. And so hopefully that continues to be the case. So sometimes just these bad tenant situation properties can be a value add. I know one of the other ones that you and I both talked about several times is how can you find a 2-bedroom house and make it into a 3-bedroom or 4-bedroom house just by adding or moving walls. Sometimes it's not even putting a big addition on a house, but if there's a house that has a awkwardly large bedroom, there was one that we bought years ago where someone had taken a 3-bedroom house and they knocked a wall down between 2 of the bedrooms because they wanted a really large master suite, which is cool, but it dropped the property value because in our area, at least, a 2-bedroom house did not sell as high as a 3-bedroom house. So we were able to buy it and put the wall back up and create a lot of value that way. So, in the end, there's market appreciation, which we're all very familiar with in the last 2 years, but then there's forcing appreciation through some of this rehab. So even in a declining market, if you can force appreciation and increase value like that and find that wall that you can put back up, find that house that's got the ugliest paint colors and ugliest 70s carpet and replace that, then maybe you can create some value that way as well.
Yeah, I just saw one of those, 2 weeks ago now. Somebody knocked down the wall or most of the wall between the second and third bedroom because they wanted to make the second bedroom into their massive walk-in closet. And it was really cool, but it tanked the property value because they just knocked away a bedroom in what was a 3-bedroom house. Now it's a 2-bedroom house. It's totally different scale. So yeah, I've seen that as well.
Those things can really detract from someone's interest in purchasing the property too. And so as we walk into a market where there's going to be more things on the market, you used to be able to 6 months ago, put the worst house, put a for sale sign in front of it and get multiple offers right away, even when there were huge detractors of that property. So now you may have opportunities to get some of these houses like this that are, a little bit less desirable, but get them at a much better discount than you could a while back.
Yeah, and especially as we're seeing the inventory start to shift, I think, what I'm seeing right now is that there are properties sitting on the market that if they are that kind of the worst house, right, like you mentioned, they are just sitting there. They're not being purchased because buyers have the ability to be a little bit more selective than we were in the last 2 years. And so on the investment side, on the owner occupant side, I'm seeing it pretty commonly where those houses that need a ton of work or that really are at the edge of being worth it, they're just sitting. It's not worth it. It's easier to wait for the next property to come along or look at the other 5 houses that are available down the road. And it's not quite that available yet, but we're starting to see that turn toward a bit more of a buyer's market, at least considerably more than we did in the last 2 years.
Yeah, I think that's one of those aspects of the market shift. And Nate, I know the third thing we wanted to talk about was where the market is going and how the market may not be worth counting on the market to save a bad deal. So with your realtor hat on especially, can you explain that concept that we've teased a couple times now of not counting on the rising tide to save a deal?
Yeah, absolutely. I think, when the market was increasing 20% a year or whatever it has been for the last year, it was pretty easy for just about anybody to buy a house on the MLS. You could pay full price or even over asking price in a lot of cases, put a tenant in the property, watch it cash flow because the mortgage rates were so low, the interest rates were so low, and rents were rising. And the property would even be worth more at the end of the year, right? You could turn around and then sell that property and put money back in your pocket. And even if that property didn't turn out as a great rental, that 20% appreciation it was easy to walk away with a big check. Like I said before, everybody looked like geniuses because it was easy to buy a deal just because the market kept bringing everything up. And some of that may have been skill, right? There's absolutely people out there that bought great deals over the last 2 years. I have no doubt about that. But also there was a fair bit of just market forces driving everything to look like a great deal at times.
Yeah, and I think it's important for investors to be honest with themselves in that overarching real estate market trends of looking at what were the contributing factors that made that a successful deal or not. Was it that the market saved that? Or was it that there was something that was done at the purchase or rehab process that really created value there? And so, particularly for value add investors, if you do like going in and buying ugly houses and making them less ugly, if that's your approach to real estate investing, then yeah, was that working, or is there something that needs to change up? I think that this is a good time for reflection onto deals that happened in this last year or two, and do I need to be more disciplined, better with the spreadsheet, better with my rehab math, better with whatever, in order to make sure that houses continue to be deals moving into 2023?
Yeah, and I think the thing to keep in mind, like we mentioned earlier, is that the corrections are going to be different if there are corrections. Again, I think there will be, they're going to be in certain market segments, right? It's not going to be at every price point. It's not going to be in every location. But I think those areas of the country or the areas, the neighborhoods where we saw just huge, huge increases in value year over year over year, I think there has to be some pullback on those. And so those are the ones where I'm keeping an extra close eye and trying to be more diligent about it, like you said.
Yeah, and to try to make this really tangible, I know like one of the things that I'm looking at moving into 2023 is I don't want to sit on like a year-long project or an 18-month project. Like I want to make sure that if we are going to do some sort of value add, that it's going to be a pretty quick job so that we don't have a lot of time for the market forces to play out. We know that from start to finish, hopefully there's not going to be that much movement. And then I'm also penciling in that even though we're trying to go fast, if we don't go as fast as we hope, or if there is more market shift than we expect in that investing period, I'm penciling in that stress test that was talked about a few episodes back of what if the market drops 10%? What if mortgage rates go up 1% or 2%? What if the market drops further than 10%? At what point does this go from like a pretty good deal to a okay deal to, well, at least I broke even to I'm going to get hurt on this one, and trying to figure out what that difference is so that I can play that through and figure out kind of likelihood of each and then push that against my risk tolerance to see, is this a purchase that I'm comfortable making?
Yeah, I'm in the same boat. In fact, I just was advising a client yesterday, and we were going through a CMA, looking at their property and trying to determine what we think it might be worth, if they did some rehab work to it, and so on before we buy it. When I pulled the final numbers, I said, "Look, here are the comps, but let's take these and drop them by 10%, right? Just so that we
Mhm.
know if these are the comps today, and we're talking about a 6-month window of rehab and refinance, we need to plan for at least 10% correction. And if the numbers still work," and they did, but if the numbers still work, then let's pull the trigger, right? I feel pretty confident that even if that happens, we're good, especially because the plan for this particular property was a long-term buy and hold. So if everything goes terrible and we have to sell it in the year, I still think we're okay. But ideally, we can ride out that market downturn if there is one, and ride it up on the other side when they hold this property for a long time. So I like planning for that and then making sure the numbers still work even with that downturn factored in.
Yeah, and I think it's super important what you mentioned there about going back and applying some kind of correction factor to comps, because I know a lot of times when you're looking at, well, what did stuff sell for in the area? Most folks that I talk with are looking back in a 6 to 12 month period. And if we look at what was the market doing 6 months ago or 12 months ago, that was the hysteria of multiple offers
Yep.
and huge over asking price things. And so the market just isn't behaving that way right now in a lot of areas. So applying that correction factor, there was a lot of time where you could look back 6 or 12 months, and that was relatively predictive of what's going on today. And I think there's a lot of areas where it's just not.
Yeah.
And so having someone in your corner that's helping you with that math, I think can be really helpful moving forward here into 2023. But really, as we wrap up here, those are kind of the three things that we wanted to make sure that folks are thinking about into 2023, and at least you and I are thinking about into 2023 is right, like running the numbers very carefully, like sticking to fundamentals and being disciplined in the math, not falling in love with the property, but recognizing it's an investment and it's a math problem. Second is looking to add value where you can. If you can force appreciation, you can hopefully overcome any sort of market forces there. And then third one is not counting on the market to save a deal, but instead just being comfortable with, if the market corrects, am I still okay?
Great points, David. And I'm glad we put this together because I think it gives a bit of a framework for people to start thinking about 2023 and their goals and how they can approach deal analysis and all the pieces that go with it. So hopefully that's helpful. Again, really encourage you guys to check out the deal analysis spreadsheet that David and I put together. That's at yfprealestate.com. There's a button right there for download the real estate deal analysis guide. We've got a guide on there that you can download, which is fantastic if you're looking for kind of the basics. And then again, we've got the Facebook group. The YFP Real Estate Investing Facebook group is an awesome place to connect with other pharmacists and investors, people doing what you are either trying to do or are just starting off doing. And you can throw questions out there, get opinions. David's thrown houses on there to get an idea of what paint color to use on a house before. So it's a great place to kind of connect with others that are doing the exact same things you are. So hopefully that helps you guys, and hope you have a great start to the new year, and we'll see you in the next episode.
Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard on today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with Nate or David, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group. As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content in this podcast is provided to you for your informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on this podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist, unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.